We're glad you could join us on the latest edition of your weekly most comprehensive look at the world of business and economics. Welcome to Business Redefined. Tonight, we are talking about a subject which many of us think is discretionary, but it is critically important, and that is the matter of insurance, and specifically bank assurance, which refers to the synergy created when the banking sector comes and meets the insurance sector to help deepen the penetration of this product. And to help us make sense of this, we are joined by Mr. Egri Mulumbi, who is the Managing Director of KCB Insurance Agency. Mr. Mulumbi, welcome on set. Let's begin by looking at the industry as a whole. Insurance penetration remains a teething challenge in this economy. If you look at the latest data from the market regulator, the penetration is about 2.34%. The global average is about 7.2%. How would you say COVID-19 has impacted this penetration?
Yeah, this year has been pretty difficult for insurance. There are two sides to insurance. There's the general, which deals with protection of assets, and there's the life, which deals with protection of the human life and deals with the savings component. And savings tends to be discretionary after you have done your initial consumption, basic needs. And in these difficult times, customers have indeed found it very difficult to look after themselves. The economic circumstances have not been as good as we planned for, and therefore people have had less disposable income to spend. So on that aspect, insurance has suffered, being a discretionary savings opportunity. Then I come to the protection of assets and just owning that asset. Most of the assets need to be used to generate the income that will support the expense incurred. And if you take, for example, motor vehicles, a lot of people grounded their motor vehicles during the period during the lockdown periods, less travels. So this also was not taken up, the motor insurance, for example. And the constrained income therefore impacted the insurance industry negatively. But on a positive note, what I've seen is increasing concern around protection. People want to be sure that their health is taken care of. So in our case at KCB Insurance, we've seen an increase in uptake of our health insurance products. This may sound funny, but initially when there was a rush to bury people who had suffered from COVID, then because of lockdown, we could not come into our usual social gatherings to raise funds for the interment of our deceased. Then people started looking more at that kind of insurance, which could take off that burden away from them. So there are lines of insurance that have done well this year. And the COVID created enhanced awareness and therefore uptake, and there are lines that have really suffered.
To hold you there, Egri, and speaking about the mixed bag, clearly you're saying some business lines are doing well, some are not. How would you say your gross premiums have evolved in light of the COVID-19 shock?
Yeah, for KCB Insurance Agency, significant growth, about 30-40% growth in our premiums. And this is informed by a lot of investments that we put in place, customer education and customer support mechanisms. You will see that we have some two products which really speak to the situation at hand, the Simba Health and the Simba Afya. That's just a brand extension of our health insurance plan, and working with the very reputable insurance partner, APA Insurance, we were able to quickly converge and find a way to support the customers by when there was all this claim about COVID-related situations not covered. In our case, we converged and agreed that we will support our customers affected by COVID. So that health insurance was a major driver of our revenue growth in 2020, despite the difficult times.
An interesting point you've raised then, something which I'm sure is of great public interest out here. When you talk about providing support for COVID-related situations, the question is, how do you assess that level of risk? Because in a pandemic scenario, no one has a good sense of what tomorrow looks like.
is really about applying ourselves. And in the COVID situation, by the way, the data has been available on a daily basis. You know, the infection rates daily announced at some time the Minister for Health was doing this, the Cabinet Secretary, every day. And what we looked at was the highest that we were getting to was just slightly above 10% infection rates. Then we started looking at, of these, how many were getting into serious hospitalization needs, and how many of those would be our customers and would be our staff. So we quickly connected with health service providers, and by the way, we run our own administration scheme for the outpatient, and we would therefore track the progress. So we supported with the testing through the outpatient, which is an administered fund, where employers or individuals would allow us to go into their limits and just support them in the testing. That was the first level. When it came to hospitalization, using our strong relationship and through our insurance partner, the APA, we were able to get our critical condition patients into hospitals. So in terms of assessment, and I can tell you that our portfolio has not gone off. We really, in terms of loss ratio, we are just on track. Close management, going through our team of health professionals employed within the bank, speaking to these customers, telling them how to manage the situation, supporting them by working with them through the hospitalization process, helped us to keep the costs pretty low.
I like the tangent you've taken as far as the loss management is concerned in the business. One key challenge I get from players in the insurance sector is an asset liability mismatch. How does this look for you, especially in light of the situation we now have?
So this has been taken up by the regulator and pretty well. You know that the circumstances around capital structure for insurance companies in the risk-based capital regime. So depending on the type of business you are investing, you're underwriting, your investment strategy and liquidity position of your business must then speak to affordability. If you're in medical business, and we've seen in the past a lot of property, commercial properties put up by insurance companies, this ideally speaks to the life insurance fund because it's long term, but cash outflows are heavy in medical, so I would not expect that we're having medical insurance premiums invested inside properties. And there will always be a lag. So the two things we must look at in terms of asset is hold our premiums in short-term investment instruments, T-bills, and liquid assets, but we must do an alignment. You get premiums for a longer period of time. You must be able to collect it in the first place, collect it fully, invest a portion of it in shorter term, depending on your cash outflow profile, which you will be able to determine from the practice. So for short-term business, alignment required by investing the money, which speaks to the levels of claims expectation, that the outflow that you expect from your fund should be in more liquid assets, and then a bit of it into the longer term. But over a period of time, even if you're in general business, then you will start building up cash reserves that will speak to claims incurred but reported later in future. That doesn't apply in health, but applies a lot to property insurances and other property classes. So your reserving policy must also be sound. And I like what the insurance regulator has done, trying to enforce this new regulatory regime, which speaks to management of cash flows and investments to align to the risk profile of your portfolio.
I agree. I like the point you've raised about the liquidity management and how easily you can liquidate your assets. One of the key challenges I see, I could be wrong, you could correct me in this, is that Over time, over the last 2 years, we've seen a bit of softening of the yield curve because clearly you deploy a lot of your assets in the fixed income, but the yield curve has been coming down. So from an income horizon perspective, how do you see the medium to long term looking like?
But insurance business, the first priority of any insurance business will be to underwrite profitably, which means that the premiums we take and the claims we pay, that should, plus the administration expenses, should give an insurance company a reasonable margin, 10 to 15% margin out of, and that's called underwriting profit. That has been a big challenge in this country. The market itself is a bit soft. We have too many insurance companies going for the same business. We tend to focus a lot on government big corporate organizations, and we go through a tender process. The downside, and this is my personal view, on the tendering for insurance services, where we are looking for huge cash injections into our portfolio, tends to take away the prudence in underwriting, and we look at the lump sum cash inflow into the book without aligning it to the claims profile. And you will hear people talking a lot about price undercutting, and then there's no regulation around pricing. You just have to be able to fund your risk. So we then going back to shareholders and telling them, please put in more money, we are not making profits. The converse is what we should pursue. Make underwriting profit, comply with the regulatory guidelines, and from the healthy underwriting profits you're making, build reserves. Then you look at investments, and if you have reserves, now you can start to manage your investment profile differently. One, there's that portion which is for regular outflows, the liquidity management, then the reserves that you are building up and accumulating over time, which essentially some of them start belonging to shareholders, the retained earnings. You can look at longer term investments, and that will deal with your investment returns to shareholders, as opposed to just looking at a trajectory where you're managing premiums for 1 year and you're looking at the yield curve on an annual basis.
Right, and that point by Egri Mulumbi takes us to a short break. Business Redefined will be back, and when we come back, we'll be discussing more about the nexus between banking and insurance, and that's bank insurance. Stay tuned. Right, welcome back to Business Redefined. Tonight we are discussing matters insurance, specifically bank assurance, and we are privileged to have Mr. Egri Mulumbi, the Managing Director, KCB Insurance Agency. Welcome back on set. The bank assurance regulations of 2020, how would you say this has impacted the landscape you operate in?
I think this is a fantastic thing to happen. Just the first attempt by the regulator first to bring sanity into the distribution piece. One key problem for our insurance industry in this market is the distribution, misalignment of distribution to customer needs. And then sometimes products don't speak to the needs of the customers. So the bank assurance regulations, and I was actively involved. I'm chairman of the Bank Assurance Association. So the first important thing is that IRA has developed these regulations in close consultation with the industry players. I know other stakeholders, the other intermediaries came in and they had varied views, but we then got a comfortable platform. The license renewal for 2021 has been based on the guidelines provided by IRA, and going forward, this comes into effect on 28th February 2021. Some of this we could not immediately implement. For example, a requirement to change the name of bank assurance agencies from agencies to a special class of intermediaries called bank assurance intermediaries. This creates a third distribution channel, and I know there's a fourth one coming. The first one is the traditional agents. Yeah. Second is brokers. Now we have bank assurance intermediaries, yes, licensed as such. Yeah. And going forward, I think digital distribution is going to play a major role. And I'm looking forward to how IRA will support in creating the right regulatory framework to support that.
Agree. There's an argument out here, I don't know whether it's correct, that bank assurance tends to work more for banks than for insurance agencies. And I'll give you a case in point. If you look at motor insurance, for instance, it is easy for a bank to sell it because, of course, you're extending car loans. So therefore, once you extend it, then you latch on this other product. Would you say this is the case, that it's working more for banks than it is for insurance agencies?
I think that's the very first stage of the development of bank assurance. Yeah. And I will just try to bring in the connection, because through a bank, customer consumption data and analytics must come into play for bank assurance to work effectively. There's the captive product, and the industry has tended to use low-hanging fruits. So it's also not possible for a bank to have, in my view, multiple partnerships with every single insurance company. You will not be able to achieve optimal results through customizations. The insurance company may not find it worthwhile to invest to develop any proposition CVPs for the customers with you. So what I would look at is pick customers based on cultural alignment, service alignment, and the promises. Can we create something together and deliver it together, and then adequately compensate the channel and the distribution? Then from the bank perspective, I'll look at customers, understand the data and position. So I'll do the motor insurance, but this same customer has an income pattern, has a family. I can understand this from their consumption patterns. They have a credit card. I can offer a lot more insurances by understanding the customer from the banking perspective than just dealing with the low-hanging fruits. That sometimes speaks to lack of creativity on our part. The opportunity is huge.
In this day and age, it's impossible to talk about insurance in a developing market such as ours and not talk about micro insurance. What do you see? How do you assess the traction that has been gained by micro insurance? There are varied views out here. Some think it's a bit too slow. Some think it's just faring on as it should.
I will really focus on what we are doing at KCB to drive that. I'll give you 3 instances which speak to that. But microinsurance speaks to low-cost insurance, low sums insured that's affordable by the micro segment. So come back to a banking enterprise, a banking setup. Banks will have customers in various tiers. Micro and SMEs tend to fall in a certain group of customers, and then you're building them up. And if you look at the distribution channel to reach that segment, the micro, then you start looking at the agency banking, which is underutilized for delivery of insurance products. So my take is we need to leverage the distribution channel through which the banks are reaching the micro segments and engage our agency banking platform so that we provide a solution to those customers, the mamambogas they are dealing with. But let me just take you off that and demonstrate how we are doing it at KCB, because partnerships is then the next key thing. The Digital Taxis Forum is a group that came together, the Ubers,
yes.
All these digital taxis coming together, and little cabs and the borders. And we had a partnership. We launched this in the first quarter of 2020, where a person just logging in on the day will get data from Safaricom. For 100 shilling deducted from their takings for that day, data from Safaricom, get part of that money saved at NSSF, get their medical insurance at NHIF paid for, and then get personal accident and funeral expense policy paid for through KCBIA, and one of our insurance partners was underwriting this. We got about 5,000 people to join. Then there was the disruption of the COVID, but that's the other way to go. And we are now extending this to the mamambogas in the various markets and just looking at how do we bring them together, create solutions that speak to their transaction activity, if on a daily basis or market days, and then offer solutions that speak to their needs in their circumstances.
You've spoken about the border sector, and I think it's a very interesting point because many times I've spoken to players in the insurance industry about the potential of tapping into this vast market as I normally perceive it. The issue is that one, the market is unregulated. Two, it is pretty high risk. A number of players, you can't tell whether they were trained adequately or not. So how do you do your risk profiling in such precarious segment, if I may call it?
So you come to the border and what is it that you really want to underwrite? There are different solutions that this person needs. First is an individual. He needs to protect himself. He is out there exposed on a daily basis to accidents because he's on the road most of the time. A personal accident policy is good for him. I know there are those little exclusions, for example, on motorbikes beyond a certain CC level, which becomes porting rather than a normal transport. But those are the things we should be able to negotiate, and we are able to negotiate for inclusion. So we look at their solutions. We are not just looking at the third-party motor insurance in this space. We are looking at protection for the family, protection for this individual, and protection for the important assets that they have. Through border activity and a very important economic activity, this person will acquire household items. They will start to invest somewhere. They've developed their own property, put up their houses. They have children to educate. They have a family with medical needs. So we must start to pick the risks that are capable of being underwritten, and from the funds that they are generating on a daily basis, offer those solutions. And one other obvious area is the fact that these people will have taken a loan from a bank to buy the motorbikes. There's a credit insurance for that. Then there's the asset, that motorbike itself, to be insured. So when we talk about there being too risky, we have to go out there and say, this risk class is too risky, or we are unable to underwrite, but the same individual, the same business has these other needs, and they have the money, the ability to pay, that we can underwrite. And we are doing that pretty well.
You know, people speak so optimistically about the vaccine, but we do know that economies tend to recover with a bit of a lag effect, especially in an industry where your day-to-day revenue would be based on discretionary spending, not necessarily what someone would say is a basic need. Doesn't that dampen your spirits a bit?
But I've just talked about identifying the areas of opportunity. If people are going to invest in agriculture, during the pandemic, a lot of people have also spent that extra time in their mjengo, a normal thing in Kenya. So I have more properties to insure. And I'm creating a platform, the digital platform. A lot of players in the insurance industry, the banks have already done that and are closing branches. So the face-to-face interaction may go down, but from data and analytics, understanding our customers from their transaction patterns, we should be able to position the right needs that speak to the circumstances. Health is no longer a discretionary need. Uptake of health insurance will go up, savings for education will go up, funeral expense will go up, and then those assets that people have developed over the period, including the technological platforms, the iPads, the phones, people will be more conscious about the possibility of losing them, that there will be an increased uptake in some space as others may suffer.
How would you say you're supporting the overall business if a shareholder is watching and curious to understand how your overall performance is as we close briefly?
First, we make the customer value proposition of KCB complete. I spoke about the lending and what the underlying assets are created of business, and then the completeness by ensuring that we have ensured that there's no downfall for our customers due to insurable risks. Secondly, it's a revenue generating activity, and through that is one of the most profitable businesses. I'll not tell you how much, but pretty profitable for the group. And thirdly, and very importantly, Just the fact that now we are offering a full range of financial services to the customer keeps the customer talking to us, and we are able to lock a few of our customers away from the competition and increase loyalty. So it's a very important business for the group.
Egri Mulumbi, the Managing Director at KCB Insurance Agency, has been speaking to us about the bank insurance and insurance industry at large, I should say. We have been focusing on this and will continue to focus on how we can mitigate the risks which come with unpredictable events, such as we saw with the COVID-19 pandemic. Up next is the Markets Report.